Right, first rates nevertheless, 54 points higher for Nifty 50. It's a good start. And the push, I think, is not coming from banks for a change. The push is coming from a Infosys, from a Tech Mahindra. It is coming from a Wipro. So IT is in a sense pushing the markets higher. Where is Infosys? It shot up smartly, and it shot up very, very smartly in the last 1 hour of trade yesterday. It's off to another good start. Not too many newsmakers this morning, but you got to look at IndusInd Bank post numbers and Federal Bank post the fund infusion announcement. And IndusInd Bank, when markets start believing that you will continue to deliver on a sustainable basis, the re-rating starts. 50 rupees higher for IndusInd Bank. And Federal Bank raising capital, price to book goes higher. They'll have to deliver a much more before markets get confident. So Federal Bank markets are saying, okay, good news. IndusInd Bank markets are saying, let's give it a double thumbs up that for the third or the fourth quarter now, they've delivered. But the breadth, unlike yesterday, I think is looking meaningfully better.
Yeah, meaningfully better. IndusInd Bank really doing the magic, and brokerage reactions also have been pretty positive. So Morgan Stanley maintains their overweight stance. They've hiked the target price to now 1800 from the earlier 1725, clearly indicating further upside and headroom to IndusInd Bank from the current market price. 3.25% higher. IndusInd is clearly your big star performer this morning. Also, Titagarh, I want to check in on what that stock is up to. HSBC has initiated coverage on the stock with a 35% upside from the current level. So the target price of 730, 554 is where that stock is. It's a 2.6% uptick that you're seeing on that stock. And then NTPC as well, wherein Goldman Sachs has initiated a buy, target price 265, saying that this is going to be emerging as a winner in the transition. NTPC is the other stock that I'm talking about. Will just come off you on your screens. For LTTS, of course, it's been a muted first quarter. Tata Power has Goldman Sachs has initiated a sell on Tata Power, target price 190. Tata Power is currently in the red as we speak right now. A couple of other stocks, and ICICI Lombard also came out with their numbers. Their gross premium has risen about 19% on a year-on-year basis. A very muted reaction is what you're seeing on that stock. Amara Raja, look out for this because Clarius ARBL has sold their entire stake via a block yesterday. That stock is holding up by about 1%. And then Rallis India, in which Rekha Jhunjhunwala has brought down her stake considerably, is the other stock that I want to revisit, 0.5% higher for Rallis as we speak right now. There's, of course, Adani Transmission as well. The units sold in the first quarter has risen 7.6% on a year-on-year basis. So that's the other stock which is in focus.
It's startups who bought from Rakesh Jhunjhunwala. So it's an interesting transaction. Rarely do you see that Ultra HNI has sold and a promoter, in this case Tata Chemicals, backed by Tata Sons, has actually bought into it. So for me, it is this entire nature of the transaction. I mean, HNI investors always sell, funds always buy and sell, but it's the promoter in this case which has bought into Rallis, and their stake now in Rallis is about 50%. So it was not that it's below 30-35% that the Tata Group had to increase their stake, but that's the view. A couple of years ago, they increased stake in a lot of other Tata companies, and we thought why? And look at Tata Motors, Tata Steel, where the TCS cash was used by Tata Sons to increase the stake. So interesting. Alright, A. Bala joins us now. Let's take a conversation forward. Let's understand from him that right now what is the best way to approach this market. Bala, fantastic to have you back. Thank you for joining us. It's been a good year. It's been a good run. Is it time to exercise caution, or is it time to just enjoy the joyride?
I think one should continue to remain bullish for a variety of reasons. One, the Indian macro fundamentals continues to get better and better, whether related to the interest rate movement, inflation lot under control, macro factors like fiscal numbers are far under control. For currency reserves have been rising, current account deficit is almost coming to the positive kind of levels, and flows also been quite decent. On top of it, as you earlier mentioned about some of the results of the current quarter, reflects the buoyancy that we have been talking about it in terms of real numbers. There's no disconnect between the earnings of the companies and the market momentum, and there's no disconnect between the macroeconomic factors and the fundamentals of the market. So that's being the case, I would assume the buoyancy will continue. I think valuations is always a question mark which comes. I have seen historically the valuations will come under the question mark only if the economic growth gets stopped or it actually gets into the reverse gear. and which is not doesn't seem to be the case as it stands today.
And these only flows which are driving the market, because I agree the macro tailwinds are beginning. Earnings are okay. But earnings are going through incremental positive. There's an incremental change in macro. There is an incremental improvement in earning. But there's a marked improvement in the health of the market. There's a marked improvement in the way how mid and small cap stocks have recovered. So if the rate of change is going to be incremental, the market move has been exponential.
Correct.
It is not adding up. This means it is a liquidity driven rally.
It is a flow driven. There is absolutely none of us are expecting, the whole market was not expecting the FII flows to reverse that fast. I think the speed at which they moved out, probably the same speed or maybe even higher speed at which they have come back, is also because of the kind of flows that went into China did not have the right experience for them. Therefore, emerging market allocations, which I am told, 35% of the emerging market allocations that come in the last 3 months have come to India.
35% of the total allocations which come to emerging markets have come to
India. Which is one of the highest that we have ever seen.
And is that likely to increase going forward?
I think it could, because the more you talk to the overseas investors, the more you see how global markets are looking at India. It's completely different from what you have seen maybe about 3-4 years back. Therefore, the FDI and FI's flows, I think would probably continue to remain strong. NRI remittances have been rising, which again, despite the overseas interest rates are quite high, and there is absolutely no need to remit in India because they will get enough opportunity they will get in overseas market. But given also the fact that if among the developed market, US, assuming scenario, it gets in some kind of recessions, then naturally they have to go after the market which has got some promising growth aspirations. That I think India probably figure in that. There's absolutely no denial on this, Nikunj. I think flows always have been a primary driver. And fortunately, when there was an FII's outflow, domestic institutional investors actually came in handy to protect the downside, and therefore that gave us a stability.
Why are they selling right now, Bala? Because on a daily basis, in the last leg of the rally, about 400 odd points, DIIs have been sellers.
I think it's always a good sign. Whenever we see the rate of flow, I think even in mutual fund industry, the rate of flow have also reduced a bit. I think there used to be about 25 to 30,000 crores kind of net inflows. Now it's come in the range of about 9 to 11,000 crores kind of net inflows. So that's the range in which it's come.
Must be more, no? Because SIP is 15, right?
SIP 15, I think if you look at the aggregate,
SIP minus outflows.
SIP outflow, if you take the net inflow is about 11,000 crores, and on average we can take at this point of time. The run rate used to be somewhere around 24, 25. And which I'm not worried about it, because this flow is always, we have seen this kind of transition period. But this flows will, of course, come back as we start seeing the good experience coming in. I think the fact of the matter is domestic investors selling in for, of course, either for increase a little bit of cash levels, as you may pointed out, is the market is running too fast? Maybe some bit of profit booking will come. This time, fortunately, the majority of the companies did not perform well for the last 2-3 years. Have started performing like FMCG companies, MNC companies, who have been underperforming for quite some time. Suddenly we saw actually renewed interest because valuation at the end of the day is catch up. So it's moving from one to other, I would say. But I think in the broader basis, if you look at it, I think the buoyancy remains. Even the recent monsoon concern which was there, like El Nino effect will have a huge impact. In fact, the rain god has been quite kind for India.
Yeah, and so just wanted to get in your perspective then, given that you're talking about all of these factors being supportive, where is it that you are, looking at strong potential? For instance, the auto sector has really seen a strong up move. Do you think that now the road ahead is also looking promising, or a lot of the positives have been baked in?
I think auto will continue to see a revival, especially with the economic growth coming back, and then supply chain is getting better, and infrastructure investment continues to remain very, very strong. I will probably see commercial vehicles, even passenger vehicles. We have been seeing some kind of pickup. Buyers are coming back, and there is also economic model seems to be suggesting that commercial vehicles probably they'll make more money, right? That's the way I think they all take their buying decisions. So that seems to be happening. We are seeing some kind of revival in the rural economic spending. I think the agriculture output continues to remain very, very strong, which is the case as of now. I think the rural spending will come back. Therefore, I also believe that FMG sectors also could get the benefit. I think other area where the market is discounted, I think not just only about growth in sales coming in, the input cost has come down quite substantially. I think if you take oil price led input cost has been quite stable, rather down, I would say. For automobile sectors, input costs coming from the steel and aluminum prices are down. So these are some of the things also is playing a role in some form or other in terms of margin improvement. Therefore, the numbers will look better and so on and so forth. But I think broadly, if you look at consumer spending, I would assume would start picking up. In addition to the sectors which have been bullish like automobiles or capital goods sectors or the banking and financial sectors. And credit growth itself reflects how consumer behaviors are happening in the country. And the recent report also once again reinforces that banking system is very sound, NPA levels are the one lowest, and default ratios have been coming down. These are actually is the something we should feel proud that yes, banking system got streamlined so much last 4 or 5 years. The risk in the system is also to the extent gets reduced.
So Bala, when we started the year, the general view, and that's your house view, was that you will get 10 to 12% return. That is what should be expected. You got that in 3 months.
Yes.
So what you expected to get in full year, you've got in 3 months. Because
Now
I'm
what?
going by now what? So do you say that, okay, I'm going to ride or I'm going to book my profits? Because I'm just going to go back to your projections when you did your annual Birla AMC summit. You said equities 10 से 11%, fixed income 5 से 7%. That was the expectation. That has happened in 3 months.
Correct.
So then what?
No, I think
So you have to change your prediction or book profits. एक तो करना पड़ेगा.
We have done some
Change
analysis.
the guidance upwards.
No, that view
revise it
doesn't change,
upwards.
frankly. I think we have done some analysis. In a every 3-year cycle, if you take the last 25 years, you put in a 3-year bucket, every 3-year market forms new high, and every 3-year, within the 3-year market also forms a low. That low is always higher than the previous 3 years low. I think it's basically it's little up compared to the previous years and keep moving up like that. So you also, of course, have to catch up with the earnings as well. But from investors' point of view, the 12 to 15% is the expectation that one should have in equities. A simple mathematics, which is nominal GDP plus risk premium.
So don't redeem your units.
Yeah,
don't redeem your units.
That doesn't change. I think we'll have to just stick to that. Okay. I think market whenever gives an extremely high return, we should feel happy that I got it. The bonus as one time, not necessarily it'll get repeated all the time.
So you're
But,
bracing for a fall is what you're saying.
even market goes through consolidation phase. As we have seen in the last 2 years, and if you look at the Nifty and Sensex, remain more or less flat. At the same time, certain sectors did exceedingly well. I think we saw a huge divergence in terms of sectoral performance. We saw whole of last year, ITS sectors gave negative return, did substantially lower than the index itself. If you look at index outperformance, index underperformance, there's huge deviations. And it's also coming on the back of the increased breadth and depth in the market, also making such kind of volatility. From money manager's point of view, need to have construction of portfolio. We'll have some winners, we'll have some losers. But expectation point of view, then the 12 to 15% kind of expectation should always remain as far as the equity is concerned, even if you go by the historical standards.
What about IT? You think worst of the price damage is behind us?
I think the balance sheets are strong. I think the companies are sitting on a huge amount of cash, and they still remain relevant from the global outsourcing point of view. The recent example of Infosys winning huge orders now, it's all reflection of the role that they all play in the international market on the IT as a technology space. Therefore, ultimately, everywhere the valuation will catch up. Market punishes them for a variety of reasons. AI as new has come, and definitely it pulled up certain sectors globally. We'll see its own consolidation phase. There is a different school of thought that exists. Unfortunately, Indian IT companies, all the leaders, major Indian leading IT companies, have also made their course correction in the last number of years. After seeing the IT fall in the year 1999, most of the companies have changed the business model in such a manner they remain relevant throughout the period, given the fact there is a role that they play. So I think if you go with that strong balance sheet, ability of the companies to buy back shares, give a high dividend payout,
Adaptability.
adaptability, I think all those things should definitely help in IT companies to come back on the radar.
So for the moment, which to your mind is the most overrated sector and the most underrated sector?
I think I would say more than overrated, sectors like even the banking and financial sectors run up quite a lot, and on the basis of expected growth, etc. And I'm not saying overrated. I think probably it has to go through some kind of consolidation phase, which I think could be one. Second is again auto sectors like some of those stocks have run up quite a lot on expectation that growth will come. So again, we may have to go through a consolidation phase. At the same time, there are certain sectors which are getting impacted because of exports not being up to the mark, like textiles. I have seen a complete last 2-3 years. I have seen a complete declining phase for a variety of reasons because the global markets are not been conducive enough for them to make money. This probably can say got hammered so much. Maybe there is somewhere down the line we will see some kind of pickup coming in. And I think it's a mix. I think it's very difficult to point out on any specific pure fundamental basis. Because I'm going by the market, the way the market rewards and punishes.
Sure. Bala, great to have you in the studios as always. We are glad that you could take time out.
Thank you.
Thank you so much. Polycab, that's the buzzer. In fact, holding up in trade, spurt up after its numbers also came out. Inder Jaisinghani, the chairman and MD at Polycab, and Gandharv Tongia, the ED and CFO, both join in on the show right now. Gandharv, if I could start off the discussion with you, you've seen a very strong growth of about 42% in the first quarter. Tell us a little bit about the sustainability of this kind of a growth run rate and what sort of domestic volumes do you hope to clock?
So the domestic business has registered a fair amount of growth in the current quarter. Both institutional and channel, which is distribution business, have registered a growth. As far as exports is concerned, that has also registered a growth of almost 80-90%. Exports now contributes almost 9% to our top line. If we talk about the domestic business, all the regions have registered growth. In terms of value and volume, most of this growth is actually coming from volume. Volume growth, depending on the product categories and BU, would range anywhere between 50% to 60%, and which is translating into almost 42% growth at the company level and 47% growth in cable and wire business level. The difference between the two is because of softening of commodity prices, which has resulted into price reduction for our end customers.
Right. And Mr. Gandharv, if you could also share the volume growth number?
So depending on the business the category, it would range between 50 to 60%. You would be happy to note that this was the best ever first quarterly results of the company, both on the top line as well as bottom line. So we have achieved best top line without compromising on profitability, and the EBITDA percentage was almost 14%, and the PAT was almost 400 crore rupees, which was almost 81% growth year-on-year basis.
Right. Inder, given that you are a proxy to the real estate sector, how is it that the demand trends are shaping up, and do you see this kind of growth to continue?
Yeah, demand is going to continue because the demand both in building construction and the demand of the infra and industries expansion all are in a very, very fast way today. But everybody is feeling that demand is going to come much, much more. So we want to be ready also. So even construction in a BC class cities and town is going to continue in the same speed.
And Inder, how is the demand trend for tier 2 and 3 cities?
No, 2-tier and 3-tier on the contrary, demand is increased, and it is going to increase because everybody is looking for to buy a house, and everybody looking for a good quality of the house today, and everywhere infra is going to be full-fledged. Our central government also investing a lot of money, state government is investing a lot of money to see that how the best infra we can provide to the countryman.
Right. Gandharv, what explains your massive outperformance vis-a-vis the industry growth averages? Was there any pre-buying or a one-off that explains this kind of Q1 number, and is it sustainable then?
As you know, we embarked on a project by the name of Project Leap almost 2 years back, and most of the strategic initiatives have been implemented in the last 2 years. We are reaping the benefit of those investments which we have made. We have revisited our GTM, we have reworked on our digital and processes, we have re-engineered our product portfolio. We are trying to get closer to customer, trying to get insights and investing a lot of time in new product development. All of these things are helping us in achieving a better set of numbers. And as Inder bhai mentioned a while back, the government spent both at central level and state level Plus, the private capex, which has improved over the last 7-8 quarters, is also helping us. So macro is good, and the execution capability of the company has improved over the last 2 years, and that is why we have been able to register this type of growth. We had earlier guided for 20,000 crore rupees of top line by fiscal 26, and we believe that sometime later this year we'll have to recalibrate that guidance.
Right, and you had highlighted as well soft consumer demand. What kind of demand trends are you looking at? Is there an improvement in that?
FMEG demand is basically we are not reached at the whole level of the network of the India. We are basically now little strong, little bit western, and we are increasing our network to basically whole part of India, looking for a south, east, and north, and northeast, and the east, every portion. And I think so within coming, which we are working now, we are working very hard on a focus on 2-3 states now. So looking to that, I think so within 4-5 years, we can reach the level, because demand is good. Demand is not a problem. Problem is that we are not on the ground on every place. So we will reach now in the ground within coming 5 years. I think so. Huge scope is there in FMEG, and we got all product ready. We got a manufacturing capacity, and again we are increasing manufacturing capacity, and also how to reach to the every nook and corner. We already keep making the team total together, and I think so we'll grow by every year 20-30%, but we'll have a very good big jump in coming 4 years.
Right, Gandharv, the FMEG segment has continued to report an EBIT loss. So what is the outlook then here for this business on the revenue and margins front?
Before I comment on the margins, let me give you a bit of a color on the earnings. The quality of earnings of FMEG has improved considerably if I were to compare with the June quarter of last year. Till last year, we were doing business on credit. That means we used to give credit of 60 days, 90 days to our dealers and distributors. We have completely stopped that. Today, our FMG revenue, generally between 80 to 90%, is either operating on channel financing without any recourse or on advance basis, and which is a significant improvement because it makes our business sustainable, and we have good visibility of secondary as well as tertiary sales. As far as margins are concerned, as part of Project Leap, we had guided that we will get to around 10% of EBITDA margin by fiscal 26. And we believe that momentum should start in the current fiscal itself. In the following quarters, we should see growth, both on top line and better margins. And then from this year onwards, every year, we should be able to improve on margins so as to get to 10% by fiscal 26.
And Gandharv, what about the overall EBITDA margins? Does 14% look sustainable, and any target that you've got internally?
So as part of Project Leap guidance till fiscal 26, we have been guiding a range of between 11 to 13%. Considering the leverage benefits, we can assume that range can be slightly improved to 12 to 14%. But no substantial improvement is expected in EBITDA margin beyond what we have already delivered in the first quarter.
Right. Gandharv, the international business has seen an 88% year-on-year growth and, continues about 8.9% to your business. Is this growth sustainable, or you think it's a one-off?
So exports business is sustainable business. Now we have fair amount of distribution business even in international market. We have fair amount of presence in countries like US and Australia. As a matter of fact, out of almost 9-10% of exports business, which is there at the company level, we get 50% of that from US. Last year, in the fourth quarter, the exports contribution to the top line was 10%. In the current quarter is almost 9%. We believe that in quarters to come, we should be able to maintain and improve this run rate. Exports is slightly better profitable business as of now, and that is why the company is making a lot of focus, making investment in manufacturing capacities, doing new product development, getting into tie-ups and arrangement with local dealers and distributors, and setting up warehouses. I think every quarter we should be able to add one or the other geography or a warehouse, and export should be a meaningful number by the time we reach to FY26.
So, Inder, given that the company has forayed into the EHV, what is the outlook in terms of that market? Because in India, it's expected to be a 4,000 to 5,000 crore rupee market a year. What is the update and the kind of growth potential you foresee?
EHV segment is basically market is very big, and it is going to very big because of the demand of the India industry new which is coming, and everybody part of the world is looking the manufacturing setup in India. So power requirement will be very big. So requirement power, every state has to convert overhead into EHV cables. So that demand is going to continue growth continuously because India is a market where a huge population is there. So we have to put more industries and more agriculture, more infra, power will require. So I don't think so. Even India has got a land looking to population. We got a less shortage of the land going to be future. So when shortage is there, we have to go for all EHV cables, and EHV demand is going to increase continuously.
Right, Gandharv, what is the update on the EHV segment as well about the plant which is going to be set up in Halol?
So we have an arrangement with Brook. Brook is an international company having decades of experience, and they are our technical partner. The manufacturing will commence sometime in 2026, and as of now, the plant is getting erected. The numbers of FY26 should have business from EHV.
Right, and Gandharv, the company has also spoken about a 400 crore rupee capex a year. What is the outlook? Are there any changes, any opportunities as well that you foresee in smart meters?
So we expect that capex would be in the range of 500 to 600 crore rupees this year as well as in the following year. The smart meter is an exciting opportunity, and the team has started working on it. We should be able to come back to you by next quarter with material updates on smart meter, but it looks exciting at this stage.
Okay, Gandharv, Inder, both of you, thank you so much for taking the time out and joining in today. Good to have you on the show as always. Well, from one earnings candidate, let's move on to other. Let's welcome on board Amit Chadha, the CEO and MD at L&T Technology Services, joining in on the show right now. Amit, great to have you on the show. Amit, after a first, soft first quarter, the ask rate for the next 3 quarters is to meet that 20% plus guidance for FY24 is over 4%. What makes you this confident when rest of your peers are actually calling out the uncertainty as is?
Sure. So first of all, thank you so much for having me on your show. As you know, our results, we grew about 10% year on year in constant currency. Organic was 7.5. We've had 6 deal wins this quarter. So we got a 50 million deal win in high tech. Plus there were 5 other deal wins, 10 million plus and between 10 and 15 million. And all of these entered into execution towards the end of June, early July, right? Profits came in at about 311 crores, as you're aware, a growth of again 13% year on year. Now, if you look at our Smart World business, that's come together with LTTS. That's a more H1, H2 business. So they will see a higher number in H2 as they've seen in H1, number one. Number two, our deal pipeline as it stands today is stronger, bigger as compared to a quarter ago, as opposed to a year ago. So therefore, this gives me the confidence that if we continue to close as we've closed in the last 2 weeks of June, and that decision-making cycle continues to be there, we will be able to meet our guidance of 20% plus growth in FY24.
But this growth bounce back, you expect that from the second quarter or third quarter?
From the second quarter itself. Otherwise, quarter 3 will be too late, right? And if I look at it, in fact, transportation for us grew at about 4% odd this quarter sequentially. I expect that to continue on the back of the investments we have made in electric vehicles and the software in that area, plus additional investments we are making in the software-defined vehicle space. I'm happy to share we've got close to about 200 people working in that space right now. We have plans to take it to up to about 2,000 people in the next few months. Second, is the growth in plant. It was a one-off because some of these decisions that clients had to make around design did not come through, but those have since come in. We've also signed some other significant contracts, and I expect plant engineering to come back to its growth trajectory starting quarter 2 and growing from there onwards. Medical for us was about 1% growth. I do expect with the deals that we have won for that to continue. Industrial came in tad bit smaller at 0.4%, again, because some of these decisions were delayed. Plus, smaller industrial companies are taking or not making decisions given the environment that's there. But we think we can leapfrog some of that with the bigger companies that we have and clients we have in that sector. So I do believe that that will come back. High tech, we do see some stress in the areas of semiconductor and consumer electronics. And therefore, I am not sure how long will that bleed continue. Actually, our next-gen communication business has done well. The ones came on at the back of SWC plus the one that we had has done well in quarter one. And there is enough and more traction to grow it in the following few quarters. Having said that, Semcon and consumer electronics is what dragged us down along with plant. And that, I believe, is an industry issue. And I think it will be a couple of quarters before that clears up. In fact, given where we are right now, we are very positive about growth, cautiously positive. And we're actually adding at least 750 headcount in quarter two, maybe more. Attrition has come down to 18.9%. I expect that to come down further. And I do believe that it's for us to grab. In fact, if you look at some of these reports, they are talking about the fact that ER&D globally will go from $1.8 trillion of spend to $2.7 trillion of spend by 2026, driven by cybersecurity, AI, next-gen communications, digital manufacturing, and software-defined vehicle. So as long as we can continue to invest in these areas, I do believe that there is a path and a future for us in order to make it to a $1.5 billion run rate by FY25 that we aspire to get to.
But how is it that you're going to tackle this problem, that you talked about high-tech and transportation, considering that, there is still supply side pressure? What's the possible solution and how much of a hit are you going to take because of these supply side pressures still?
So transportation, I don't think there will be any issues. I, in fact, would like to reaffirm that I'm fairly comfortable with transportation. The teams have done well. We've got some very solid customer interactions going on. Now, in terms of high tech, the only way to get past the blues in Semcon consumer electronics is to be able to grow the other parts of the business, which is around next-gen comms, which is around ISV, which is around media entertainment. In fact, one of the large deals that we signed, the 50 million plus deal, is in media entertainment, and that's in the platform area. And I do believe that there's others there behind it that we are sitting on that we should try and close. In fact, we have some three-digit TCV deals. We have a number of 50 million, 25 million deals, and we will continue to make efforts to try and close it. See, one more thing that we did this quarter that was fairly different from previous times was we've established a customer advisory forum or council for LTTS. It is about 16 clients. Composite revenue of these companies is about $400 billion and market cap $2 trillion. So we believe as long as we can keep our clients very close to us and we can continue to understand the changing landscape and we be agile and invest in the right technology sector and areas, we do believe there's a path forward.
All right.
Having said that, I do want to acknowledge markets are tight and decision-making are getting delayed. I mean, instead of 2 signatures somewhere, now there are 4 signatures taking place. And we are having to work harder to be able to, and diligently, to be able to get this to closure.
All right. Really appreciate your time, Mr. Chadha. Thank you for joining us and good luck for coming quarters.
Thank you.
Markets are slow and steady. There is this unusual impact of Reliance. Unusual impact. Why? Because if you're an institutional investor, you would say, look, I would definitely want to own the new business which is getting incubated. Now, it's a new business which they are getting, which Reliance is incubating. It is not a sum of part which already is there, which will be, which will get created. So if this business grows, you essentially will see a hyper growth business based on digital, framework, and which will address to financial services. So it will compete against Bajaj Finance, Policy Bazaar, even traditional banks. So it would be a very interesting futuristic business which everybody would like to own. But today being the record day, and for those who want to really buy the business, they know that they'll have to buy the share of Reliance today, which is leading to this unusual adjustment. Also, the last day of of Reliance in the F&O market, a compulsory factor would be at play. So you cannot roll over your long positions or short positions. You have to unwind them. Short sellers will have to square off. Long traders, if you don't have the appetite or the capital to roll them over, you will have to cut it. So there will be an unusual price action in the Nifty because of Reliance. So today's price action needs to be really considered in that entire framework, so to speak. Gopal Balachandran, CFO and Chief Risk Officer with ICICI Lombard joins us. Now, Gopal, good morning. Thank you for joining us. Growth in your focus area, retail, healthcare, has been fairly strong in Q1. Is this growth sustainable?
That's a great start. So if you ask us, health definitely is one of the areas of preferred segments of opportunities for growth for ICICI Lombard. And exactly as you mentioned, I think we have had industry-beating numbers in the context of growth, particularly when you look at for that particular segment. And for us, when I said it's a preferred segment, it is both the employer-employee or let's say the corporate health equally as an area of focus. And the other segment that you referred to in terms of retail health is also an area of opportunity where we have been investing a lot. Now, again, in the context of retail health, when you look at for ICICI Lombard, even this quarter, we have actually kind of grown faster than the industry. Last year, again, when you look at the numbers, industry grew at roughly about 15-16%. ICICI Lombard grew at about 17%. If you look at quarter one, our retail health numbers grew at almost about 23%. Industry growth was about 18%. And that's a segment that we are very excited with and quite happy with the way how growth have played out. And even on the corporate health, again, if you look at, I think we have again had industry beating numbers. Industry grew at, we have kind of almost doubled the growth numbers when you look at it in the context of growth for ICICI Lombard. So hence, quite excited with the way how the investments in the retail health franchise is playing out. And that's an area which will be a continuing one in terms of continuing investments. In the past, we had a market share on that particular segment, which was less than 3%. We have been able to kind of make an improvement thereon. Currently, as we speak, the market share stands improved to 3.1%. But as I said, this will be an area of continued focus, both in the context of retail health and corporate health.
Okay. So Balachandran, if I can just push you a little bit more on the mix, what is the outlook when it comes to health? Is it as big as motor for you? What do you think is going to be the trend?
Sure. I think, again, as we keep saying, for us, if you ask us, all the three key lines of businesses are areas of focus. When I say all the three key lines, whether it is motor, whether it's health, or whether it is a commercial lines, all of them are clearly areas of opportunities is the way that we see for ICICI Lombard. And hence, we obviously would like to see growth momentum sustaining across the three key lines. Having said that, you are absolutely right. Historically, motor, by the way, has been the largest contributor to the overall revenues. It's been for understandable reasons during COVID periods for 2 years, clearly health displaced motor as the largest contributing segment. And as we speak, health continues to be one of the fastest growing growth segment. So hence, to that extent, even for us, when you look at it from a growth percentage standpoint, health would have kind of grown relatively faster as compared to, let's say, some of the other lines of businesses. So hence, in terms of mix, we clearly believe that health will continue to grow disproportionately faster. Motor in the past for us has been a conscious call of going a bit slow, given the reasons, significant aggression that the market has been exhibiting. Already we are again seeing in motor specifically signs of growth emerging back to us. And commercial lines, again, historically, we have always kind of disproportionately grown relative to the market performance. Hence, to answer your point in terms of mix, health in terms of growth percentages will continue to grow faster. But in terms of the overall mix, my sense is it will be broadly almost a kind of an equal split between commercial lines, motor, health, and a very small proportion of our portfolio will also comprise of crop.
Right. And with regards to your loss ratios, your motor OD loss ratio has now significantly declined to about 67%. What's causing this?
For us, claim service is definitely an area of priority. And we kind of put a lot of focus, emphasis in terms of making sure that the experience for the customer is significantly superior. Since you talked in the context of motor, I think what we have been able to significantly drive is, today when you look at when an accident happens, many a times it so happens that the insurance company is possibly last in the pyramid to get to know of the claim that has happened. That's a direction that we are planning to change, by which we are significantly looking at diverting traffic to what we call as a preferred provider network, whereby we are able to be the first notice of loss as and when an accident happens. And to the customer, we are able to make sure that the experience of repair is extremely seamless, and we are able to divert that particular claim incidence to a preferred network of garage, where both quality of repair is quite superior, and even the average cost of claim that the customer is required to get exhibited to is lower. And so there again, when you look at the PPN numbers, which typically we track in the context of non-OEM claims, the proportion of claims that we were able to divert to a preferred network of garages, that number was about 40% last year. This year, the number is upwards of 65%. So this, as I said, clearly helps both in terms of the quality of repair. Otherwise, you would possibly end up in a situation of coming back again to get your vehicle repaired, and which could possibly increase the cost of claims. And two, as I said, given that we have been able to divert it to a preferred network of garages that we kind of vouch for, the relative average claim sizes are also equally lower. So both of this have significantly kind of aided in terms of trying to keep the overall claims under check. Definitely quarter one may not be the only way to look at. Ideal thing is to look at more over annual cycles, but more importantly over periods of 3 to 5 years.
Right. So the other piece is loss ratio on the health, and that has seen a sharp rise. So I fully appreciate that it has gone from 73 to 78. But can we look at that number quarter wise? But what is the larger target or a band where you see loss ratios for motor as well as health?
So honestly, I think what we have spoken about to the market is from a combined ratio perspective, which has got both the loss ratio and the expense ratio element put together. If you look at FY23, we exited roughly at about 104.5% combined, the overall numbers. And to the streets, we had said over the next couple of years, which is by end of FY25, is when we had said we will get down to a trajectory of combined at about 102%. So that's the direction that we want to take. And the effect of this change will be a combination of improvements in loss ratios and equally some of the investments, as we spoke just a little earlier, all of them will fructify in the form of improved efficiency in operations, or let's say improved productivity. Now, both of them is what is going to aid in terms of the improvement in combined. So therefore, directionally, that's the path that we want to take to bring down the combined to about 102% by end of FY25. Having said that, I think particularly in the context of the health loss ratios that you kind of spoke about, again, these are quarter one numbers. As we keep saying, if you look at more on an year-on-year basis, let's say on a full year basis, and even if I were to split this number of 78.7% that you referred to for quarter one this year, if you look at the corporate health loss ratios, that number was roughly at about 92%. And retail health within that was about 65. Now, this is quarter one. But if you look at it on a full year basis, my corporate health was actually at about 95. My retail was broadly in that same range of about 64, 65. So that range is something that we are quite comfortable with, whether you look at both the segments. Generally, we have talked about the corporate health loss ratio staying in the range of 94, 95%. And retail health, we have generally kind of talked about in that range of 65 to 70 is the range that we are quite comfortable with. But as I said, ideally, we would want to look at it more in the combined ratio trajectory of getting down to 102 by FY25.
Right, and you did speak about OPEX in the motor space. So how should one look at the overall OPEX in FY24 versus 23? Because you did say, as per expenses of the management guidelines, you are within the limit. Talk to us about how efficiencies will play out.
Again, that's a great question, because for us, as we keep saying, there are 3-4 key areas that we significantly stay focused on. One is obviously to kind of increase distribution, because that will kind of significantly aid growth. And two, for us, we continue to stay invested in investments in technology and claim service. Now, let me give you a simple data point, because again, we keep looking at sustainable growth over longer horizons and not confined to, let's say, shorter periods. If you look at for ICICI Lombard at the peak in terms of headcount, this is way back in 2008, we had a headcount of almost about 18,000 plus. Today, my headcount number is down to less than about 14,000. This is after the acquisition of Bharti AXA that we did almost about a couple of years back. So we have had almost close to about 30%, roughly about 25-30% reduction in headcount as we speak. But having said that, if you look at the volume of policies that we write as a company, Again, for that same period, 2008, we used to write about 3.5 million policies. I mean, last year, FY23, we exited by almost about 32 million policies. So that's been a 9x increase in policy count, whereas we have had, let's say, close to 25% decline in headcount over a 15-year cycle, which roughly translates into an headcount productivity of almost about 15% over a 15-year cycle. So that's the way we kind of look at it. But to get more specific in terms of how we would see the expense ratios play out, again, when you looked at, let's say, for quarter one, as I said, the breakdown of the combined is the loss ratio and the expense ratio. The expense ratio for quarter one was roughly at about 29.7. This number was lower than when you look at quarter four of last year, which was at 29.9. And even if you look at it on a year-on-year basis, let's say quarter one of last year, the expense ratios as a element of combined, that number was almost about 32%. So directionally, I think we have been able to kind of significantly bring down the overall expense of management. And as you rightly said, for ICICI Lombard, we have always been within the threshold that the regulator has laid down. And as I mentioned, 2/3 of the market participants are operating at thresholds which are much higher than the regulatory stipulation. So directionally, once that starts to see an improvement, that by itself presents increased opportunities of growth for ICICI.
Right, and therefore, how is it that we should be looking at your combined ratio for the full fiscal?
So as I said, I think we have talked, as I mentioned, we have spoken to the market over the next couple of years to get the combined down to 102. So directionally, and as I said, FY23, we exited at 104.5. So that's a trajectory that we would want to take. Honestly, there are a lot of moving parts within that. We don't want to specifically give a number out for FY24. As I said, by end of FY25, we would want to get to that 102% number.
Now, we've seen cyclones impacting your numbers. Could this possibly be the year of El Nino? There are floods in North India. What happens to the claims because of that?
So honestly, again, that's a great question because, I mean, unfortunately, these days, because of climate change, there has been far more increasing number of events that we get to see on a year-on-year basis. But having said that, whenever this event happens for that quarter, you will obviously see the loss ratios getting impacted, which is exactly, for example, when you would have seen, let's say, this Q1 numbers for this year, we had the cyclone Biparjoy, which had a net claim impact for us of almost about 35 crores. Now, that obviously impacted when you would have looked at, let's say, our loss ratios of fire and engineering. It clearly had an impact. But your point on what can possibly change in the context of the combined ratio trajectory that I spoke about, honestly, we do price in for some of these events in terms of cyclones, flood losses, some of the individual peak losses, etc., etc. But having said that, if the magnitude of events becomes quite severe and frequent, then obviously some of those estimations is something that we'll have to recalibrate. But having said that, the good part is, I think ours is a business which is relatively of an annual nature. And therefore, if at all for some reason the experiences turns out to be an adverse, we always have the opportunity to go back and possibly look at pricing the risk appropriately. And the impact will be something that will be not specific to ICICI Lombard, it will be for the industry at large. And therefore, companies which have been relatively better for us, for example, if you look at ICICI Lombard's combined has been better than the industry combined by almost about 15 percentage points historically, between 10 to 15%. So therefore, we relatively have an advantage whenever these events are far more frequent and far more severe. Early signs, as of now, nothing concerning is the way we would look at, but honestly, too early for us to really say whether these claims could see an increase or not.
Okay, thank you for joining in and sharing with us the outlook. That's the management of ICICI Lombard talking about how there is a bit of slowdown in growth for motor, but they are looking at investing a lot in retail, and health as well has not as of now displaced motor as the largest contributor to revenues. 1334, that's where the stock is currently at. But keep the spotlight then on Reliance Industries. It's the last day to buy RIL to get the demerged shares of Jio Financial, that is. For every one share of RIL, a shareholder will get a share of Jio Financial. Let's get in all the details. We've got Somit here to share with us all that. Somit?
Well, given that the demerger date for Reliance Industries and Jio Financial is July 28th, the last date for any shareholder to buy the shares of Reliance Industries to participate in this demerger would be July 19th. Now, the ratio for this demerger is 1:1, which means that for every one share of Reliance Industries, the shareholders will get a new additional share of Jio Financial. Now, the listing date for Jio Financial is still not known. Now, what we know about Jio Financial is that the chairman and the CEO of this company are both ex-ICICI Bank leaders. It's KV Kamath, who will be the chairman of Jio Financial, and Hitesh Sethia, who will be the CEO of Jio Financial. Now, what will Jio Financial do? It will provide lending services to consumers, merchants, and it will expand in other verticals as well, like insurance, broking, payments, and asset management. Now, it aims to build a large digital fintech platform for all Indians, and going ahead, they're also open to bring in strategic and financial partners in the company. Now, when it comes to the valuation part, Jio Financial will be owning around 6.1% stake in Reliance Industries, which is the treasury shares, and the value of this treasury shares stand at close to 1.1 lakh crore. Apart from this, the company would have a net worth of close to 28,000 crore rupees. So, based on these numbers, what we understand is the company's book value would be close to 200 rupees per share, and brokerages have assigned a value of around 168 to 190 rupees per share when it comes to Jio Financial. On the listed side, Jio Financial will be competing with Bajaj Finance, Paytm, PB Fintech, Angel Broking, IIFL Securities, and Paytm, as I just mentioned. And on listing, what we understand is that Jio Financial's market capitalization would be close to 1.4 lakh crore rupees, which means that the company would be the fourth largest financial institution listed in the Indian stock market. Now, how could Jio Financial benefit? Now, it is most likely to have a AAA rating similar to its parent company, that is Reliance Industries, and this AAA rating will help the company get the cost of funds on the lower side. Now, only 6 large NBFCs in India have a AAA rating, and Jio Financial would be one of them. Apart from this, given the fact that Reliance Industries retail arm has a very large distribution base, the company will benefit from that also, because Reliance Retail has more than 18,000 stores in India and nearly 78 crore footfall on an annual basis. Apart from this, the telecom business is also the largest in India of Reliance Industries, with around 43 crore telecom user base. Now, what would be the impact of this demerger on the indices and the FNO? Now, the FNO contracts of Reliance Industries would expire on July 19th. On Nifty and Sensex, if you see, Jio Financial would be a part of the index at a constant price. And how will this constant price be discovered? Well, the opening price of Reliance Industries on July 20th minus the closing price of Reliance Industries on July 19th, the difference amount will be the constant price. On MSCI, it would be a part of the standard index, and on FTSE, it would be a part of the index if the listing is happening 20 days post the demerger.